quick on that, you're talking about the banks. If you have money sitting there, you'll have a lot of people that will lean towards a CD as an example. That's kind of a typical move that people will see, that they have, larger sums of money that they have sitting in a checking or savings account, and they might just move it into a CD. Well, this, depending on how it might be, and those are short-term scenarios, depending on how long you're putting money into a CD, there's variables there. But a product like this that you're talking about, Will, could be a CD replacement option as well. So there's options within this in terms of surrender periods, things along those lines with the annuities that fit within the CD market, comparable to that, but get even a greater return on that money outside of a CD. So there's a lot of different things, to your point, Will, that where this money can come from.
Yeah. And like Ron said, CDs are a great option, but there are also fixed annuities that do the same thing as a CD, give you a 3, 5, 7 year option that your money sits for 3, 5, 7 years. You get a fixed rate of return versus the index portion of it. The biggest difference between 401k and annuity is the distribution of that vehicle. How do you take monies out of those vehicles and actually utilize them? So, Ron, go into detail a little bit on how the distribution phase works with the 401k. Does it work the same as it does with an annuity? Explain that to them.
Yeah, typically in a 401k or IRAs, these types of products, you might hear or might be familiar with people expressing it's like a 4 to 5% rule. So what that means is that people are taking anywhere from 4 to 5%. That's how that's calculated.